Meanwhile, there is other stuff happening, tangible stuff, in fact, that should inform and really help investors, and I think encourage investors. Joining me now to discuss all these things, Kingsview Wealth Management CIO Scott Martin, TJM Institutional Service Director Jim Ario, and Advisors Capital Managing Partner Joanne Feeney. Jim, let me start with you. If the administration was looking to see how Wall Street would handle the world's highest capital gains tax, I think they got their answer. You think they'll listen?
No. Well, first of all, they could have just asked us ahead of time what we were going to think about a 43% capital gain. They didn't have to actually float that out. But remember, they are politicians. So if they're floating out a 43% capital gains rate, they know that's absurd. They probably have in their sights realistically a 30%. And then they want to make us think that we negotiated back so we feel like we got some sort of deal. But let's keep it in perspective. 30% is awful. It's toxic and destructive policy, and it's destructive for the middle class. Those people who make over $1 million that they're trying to target, those are the people that employ the middle class. So the question becomes, are they willing to signal that they're anti-wealth or against the wealthy at the risk of damaging the middle class and damaging the economy? And I think the answer to that is yes. I think they are willing to do that. I think it's terrible policy, and I think that if they really get far in pushing it, that Wall Street will have a bit of a tantrum, but in the end, I think it'll be okay for stocks.
Yeah. You know, to that point, it feels like this administration is really worried about their strategy is to win the polls and message things and public relation things and get the media to win the polls and then try to force the action. You know, Joanne, of course, there was also, even coming into yesterday, it felt like there were things bothering this market. I mean, I'm looking at internals every day at the close. They've been unimpressive, even on up days, volume drying up. Even today, we're having a really strong day, you know, with respect to the bounce back economic data, and yet volume is extremely low again. Where is this trepidation coming from?
Well, you know, Charles, I think a lot of folks are a little bit fearful. Valuations in many stocks are quite high, and a lot of investors have pretty concentrated portfolios, and they're trying to figure out what to do, potentially with rising rates on the horizon and maybe that capital gains tax. You know, that's why we think right now index investing can be particularly fraught. You know, we invest individual stocks for our clients, either for appreciation or looking for income, and we still think you can find good values here, but you just have to be a lot more selective because of those real, you know, significant concerns over some of the headwinds that will come into play, you know, once we get through this Goldilocks period of fast growth and lots of fiscal spending.
I'm going to come back to you about those individual ideas because I'm all about individual ideas too. You know, Scott, now, despite all of this angst, right, there are two things that have remained constant. The market is higher. It's, in fact, having a pretty good year so far. And individual investors remain very bullish. That AAII number is a monster. It won't go down. But I thought that, you know, that was supposed to be negative for the markets. What's going on here?
Well, it could eventually be negative, Charles. I mean, yes, you're right. The bullishness sentiment, easy for me to say, is, you know, that's a concern. And I think the funny part, as you mentioned, just with behavioral finance, I mean, you look back to some of these big corrections, whether it was, you know, last March, the 2014, 15, 16 area, the crash of '08, of course, and then other ones. When the sentiment gets really low is actually the time you want to buy. When things get bullishness at these heights, when it gets really sanguine, those are the times you should actually be somewhat careful. So I agree with you. I think that will eventually happen again because it has proved itself out over history. But the market can stay bullish and the market can keep going up until that last investor is in. That's when things will turn over.
You know, Joanne, I want to come back to you because I'm thinking about this individual stock thing and earnings season. We're 2 weeks in. Really, the only word I could use is amazing. Revenues, earnings, crushing it, much better than we thought they would be on January 1st and April 1st. But for the most part, a lot of these stocks are popping in the aftermarket, then selling off. So how do you find, I mean, as someone who zeroes in on this, it certainly must inform you, particularly the ones with these amazing numbers, and for whatever reason they're selling off. How should our viewers deal with that?
Yeah, you know, it should be expected to some extent. Expectations were really high coming into this earnings season, right? We knew these companies were getting back to work, profits were rising. So in some sense, expectations were above the official numbers. And so we're seeing
So let me jump in then. Let me jump in. Would you sell then like a Whirlpool? 2 days ago, after the close, Whirlpool goes straight up. Yesterday it got hammered. I didn't see it today. But if I'm holding Whirlpool, what message do I take? The earnings and the initial pop, or do I sell with the crowd?
Now, you look at the fundamentals. Whirlpool is a stock we've owned for a long time. We really like it here. The temporary sell-off is, some folks may be taking some profits, but you got to look at the fundamentals. And the outlook for Whirlpool is really strong because look at the housing market.
Right.
Housing market is on
Right.
fire. People are going to be buying new appliances. And that's not the only place one can look for these good opportunities. Auto's doing very well, even with the slowdown in production. A company like Texas Instruments or
Right.
NXPI really gives investors opportunities, even if there's a sell-off at earnings.
Jim, your thoughts on the earnings season so far? What have you learned? What do you like, dislike?
Well, the one thing, and Joanne mentioned it, you mentioned it too, the one thing that makes me a little bit more cautious is the fact that some acceptable earnings have been met with some selling. But realistically, for me, nothing matters as much as big tech earnings season, which is next week. So to me, I'm going to be looking at that. If this was 3 weeks ago, and I think the market was anticipating that interest rates were going to go much higher, I think they were going to scrutinize those tech earnings more based on those discounted cash flow models that tech stocks, we presuppose such high earnings in the future. Now that we think that rates are going to be stable, and thank you for bad policy for stabilizing rates yesterday, now I think some of those tech earnings will be more accepted. So I'm actually looking, and I think the NASDAQ is going to break through 14,000 in the next couple of days, particularly after those earnings. And I'm looking to get long some of those names afterwards. But to me,
Right.
earnings season is tech earnings is 60%, bank earnings is 20%, and the rest of it is just bits and pieces.
I got you. Hey, let's talk about some other catalysts for a potential rally, Scott. Buybacks. Corporations came in sitting on records amount of money. A lot of them are telling us they're going to put it to work, buy back their own stock. What does it mean for the market? And are there any names that may have swayed you because of this?
Well, I think Jim talked about some of the financials. We've seen it in some other areas where you've had a lot of cash, like you mentioned, Charles, on the balance sheets. I mean, don't forget, too, it could be buybacks, maybe some dividend increases. I mean, you're right. Cash was not only king, but cash was also all the jesters and all the servants and everything. I mean, cash was everywhere for a while, and it still kind of is.
Right.
I mean, so we have, like, this ability for these companies now to utilize that cash to issue debt at low interest rates to do so. And I think that's going to be the continuing driver that will mitigate some of the pullbacks that we've talked about in the segment so far when those buybacks kick in, when maybe dividend increases come down the line. Because don't forget, guys, as companies are out there and having, let's say back in the day, favorable dividend rates, maybe at 2%, but as that 10-year creeps up closer to 2%, maybe companies start raising their dividends in anticipation of something better down the line for their own future. So therefore, healthcare companies and things like that might actually start raising dividends.
All right. And Joanne, let me ask you real quick about the reopening trade. Is it back on, and what do you like?
Yeah, I think we're going to continue to see that play out over the year. The reopening trade's good for energy stocks. We like a couple banks, to the point of seeing increased buybacks and increased dividends. We think Citigroup is in that position, MetLife is in that position, JP Morgan. These are stocks we've held for clients for a long time, and we think there's definitely more room to run there. But you've also got like a TJ Maxx, for example, that really has underperformed, but really is going to benefit from the reopening as folks go back into the brick and mortar shops. Constellation Brands, Casey General Stores, people getting back out on the road, back out to bars. So there's a lot of opportunity out there to play this rotation.
Yeah, well, we already saw it in that last retail sales report, which probably was just the tip of the iceberg. They call it revenge buying. We'll see. Scott, Jim, Joanne, thank you all very much. Have a great weekend. Fantastic stuff. By the way, for all the White House talk about